and welcome to another edition of Nucleus Investment Insights. This week we want to have a bit of a dig into whether or not you should be worried about a debt crisis. So we have a look at this every now and again, using some of the frameworks sort of developed by Ray Dalio, and just sort of looking at different countries around the world and seeing what the main issues are. And I think it's sort of well worth having a bit of a check-in. We've had a few sort of questions from people about what are the real risks out there, particularly with these. We have elevated prices we've spoken about, and we've spoken about sort of being, reluctantly fully invested in, or reluctantly sort of taking part in it, and the idea that there could be this bubble coming. And then so the questions are, what about the downside? And so, are there debt crises that we should be worried about, and how should we be thinking about those? So just a reminder, everything you hear today is general advice, not personal advice. If you do want personal advice, feel free to book in and have a chat with us, and we can run through your own situation and what is important for you. So I thought we probably should start with a quick look at what's going on in terms of the major countries and insolvencies, because this is where typically it tends to start. Not always. Sometimes you do get it more driven by consumers, but typically the business end of the market is where you start to see downturns with it. And so we've got a chart up just showing, pretty much sort of listing into the podcast, just showing some of the major countries sort of year to date, 2024. Turkey, South Korea, the sort of the big ones, or quite small countries, but sort of right at the end, sort of more than double their 2019 levels. Now, keep in mind, for all countries, 2019 might not be the right year to compare to as well. But we can see Canada, Sweden, Australia, bring up the next part, sort of well over 50% higher than where they were. UK, and then most of Europe sort of falls into the next part. And at the other end, Singapore sort of ranking as well below, and I guess probably most importantly there, the US, so sitting around about the same levels in terms of 2024 versus 2019. So as a big picture scenario, what's interesting is the countries that you'd see right at the top there, in particular Canada and Australia, are ones where we really haven't seen interest rates sort of starting to be cut yet. And so what you're looking at is higher insolvency levels and without sort of monetary policy support that you're seeing elsewhere. And whereas somewhere like the US, it's only average levels of insolvency that sort of doesn't look like a particularly concerning cycle, from that point of view. And the UK is a little bit more, I guess you have to have some question marks about where can it go from there, and can you have a debt crisis? But certainly from looking at these numbers, you'd look at the US and say, well, there doesn't look like to be a major issue. So we're going to try and look at sort of US, China, Australia / Canada, and Europe as sort of some of the bigger regions, and try and apply this. Now, it's spoken about a debt crisis, and this is a sort of Dalio scenario, looking at a whole bunch of different debt crises over a long period of time. And mostly they sort of fall into these 7 stages that we talk about. And so that they start from this idea that you've got this early part of the cycle, and sort of you have this build up, and I'm just showing the nominal short-term rate on here. And you go into this bubble phase where potentially interest rates don't rise as fast as they should. Then they finally belatedly start that tightening at the end of it, and then finally you actually hit this point where rates all of a sudden start to plunge, and you end up in this depression era, this beautiful deleveraging, and then finally the sort of pushing on a string and normalization phase as you sort of phase through this. And I'll dig into a bit deeper into what each one of these means. But I guess the idea is that a depression is thought of as GDP down about 3%, and they're very rare in terms of depressions. And I think particularly nowadays, in that we've got much better understanding about monetary policy and the mistakes that have been made in the past, and so there is I guess biased against depressions, but it's not to say that you can't have they can't still appear, and we can't have a big enough debt crisis to cause one. But I guess what we're trying to look for today is what are the ingredients, and where, in which countries in particular, are the ingredients that that might sort of go into one of these bigger events. Now, one of the other thing to note as well is that typically when you get depression, certainly in sort of the more modern era, is that it tends to be when the debt of the people involved, whether that's or the entities involved, whether that's the people in the country and sort of households that are having the problems, or governments that are having the problems, or corporates that are having the problems, and it can be all three of them, or it can be focused in, particularly in one or the other, is that do they have a significant amount of their debt denominated in foreign currencies? And that's probably the big one you need to be looking at, because that's going to give you what's called an inflationary depression versus a sort of more typical deflationary depression. And so for the large part, Europe, Australia, the US, and China, if we're looking at sort of those main areas, most of the debt tends to be denominated in its own currency. So you're talking more sort of emerging markets if you're worried about, places like Turkey or something like that, where you can see these types of events sort of go into bigger issues. So really the big ones we're talking about at the moment, it's more likely if you do have a debt crisis in any one of those, it's much more likely to be a deflationary debt crisis. The other thing is then whether it's sort of a short-term or a long-term issue, and what I mean by that is that you can have you go through sort of various build-ups in terms of the amount of debt that you see within economies, and I've just got one up here sort of showing, which is the overall debt to GDP of various it's a global debt database, this one, and just sort of showing how our debt itself has sort of more than doubled over sort of the last 50 to 70 years. And there are periods where the debt goes backwards, and sort of back in the 70s, it's probably one of the key parts where you sort of saw that debt, some of that debt falling. But there's the question about, is this sort of a long-term build-up of debt, which is going to go through this sort of big deleveraging period, and you might see these levels fall by 20, 30, 40% of GDP, or is it just a short-term blip where you're sort of talking about more of a more of a business cycle type issue? So is this sort of in sort of terms, it's about saying, is this the big one? Is this where we've had this massive build-up of debt, and then you have this sort of cathartic explosion and debt crisis, and then the debt sort of all falls away quite dramatically, and then you start to see the next sort of build up into the next leg? Or is it just sort of more of a business cycle one? And so you might look at countries like Iceland or something like that had this big build up of debt, and then the whole thing's all been written off, and you've started the whole thing again. Or you go back to somewhere like Australia back in the early 90s, this big build up of debt, and then a big fall in debt, and then the next cycle sort of kicks off. Or is it sort of more of an interrupted one, like we saw in the 2000s, where we had this build-up of debt, but the a lot of it was all about trying to support the companies involved and support the individuals involved, and so a lot of countries we really didn't see a big fall at all in terms of the debt. And so as we look through the different countries involved, actually, in terms of this, the real problem comes up, as we spoke about before, is the issue in terms of China and what they're doing. And so the question is, and that's, we've already got deflation there. So the question is, are they headed for a depressionary? We saw some big announcements last week in terms of saying there's all this stimulus coming. We ran our podcast as well saying, look, it doesn't look like stimulus to us. And this week that seems to be the consensus as well, is that, and we've started to see some of these markets starting to fall back, is that maybe they will come out and make the announcements, but there doesn't seem to be the stimulus coming. And so we'll apply some of these factors through to China. And so one of the key parts that you want to look at is during this upswing, And so during the build-up of the debt, what were the typically what happens is your lenders are out there giving credit to anyone, even as people become more and more indebted, and it's self-reinforcing on the upside. And the reason why it's self-reinforcing is because the rising spending generates rising income and rising net wealth, and then therefore people can borrow more, which then lets people go out and spend more and buy, and so therefore we get back to the rapid spending, more income, rising net worths, and rising asset values. You can lend against them, and so that really China really stands out in terms of that. So certainly that property sector went through that whole self-reinforcing one for 15, 20 years of just those rising prices and banks lending more, and the expectation that prices are only going to go one way, and everyone taking on just more and more risk. And so that sort of stands out as a clear issue. The US, when you look at the amount of extra debt, really doesn't seem that significant. It's certainly, it's going up, and it's there's in many ways it's an issue, but it's not at levels where you'd be particularly concerned. There's pockets where, say, commercial property in the US, where you look at and you say, okay, look, there's certainly got some issues there, but those issues have been broadly known for a while now, and most of them have quite long. Most of the companies involved have quite long debt lending periods. So it's not as if they're the average loan for corporates is still significantly above sort of 5 years for a lot of these, and so there's time to work through the issues and to work out whatever the debt problems are. So maybe, I guess, within the US you'd look at and say there could be something sort of brewing there, but they tend, if you're going to have a debt crisis there, it seems like it would have happened a year or 18 months ago when those started first showing up, and we saw some of the problems in the regional banks in the US. That would certainly make sense for when you would have had that debt crisis. Now, 18 months on, where the problems have been sort of widely understood and sort of circulated, and companies given a chance to sort of get out of or mitigate the problems, that tends not to be the case when you tend not to get debt crisis sort of come from that. Within China, that's this stuff all sort of falls into place in terms of it being. And sorry, I've got a few more things I should pop up in terms of the types of things you see. Is that so? Yeah, the self-reinforcing is number one. The new financial instruments is the next one. You often see in that just new ways of borrowing, whether it's so in the financial crisis for the US, we saw all these CDOs and new ways of packaging up debt and bringing in new people. That doesn't seem to have been the case in the US or Europe as much. But within China, look, the lending within that and the amount of lending from SOEs and all these other factors sort of all does add up to new financial instruments. The distribution of credit is important in terms of saying sometimes you look at the averages and everything looks fine because you're the people that are borrowing the money. Let's say it's the poorest people who are really struggling, and the richest people are doing fine. Is that you might look at the average debt over the whole economy and say, yeah, look, there's all these people with lots and lots of money, and there's all this debt, and so therefore everything's fine because the people with lots of money and lots of assets can afford the debt. But if you haven't sort of gone in a more granular level and actually said, okay, well, the people borrowing, can they actually afford and match the income with the people borrowing, and then that sometimes means that you can throw up some issues. And so if we run through this sort of checklist we've got up, which is talking about all the a whole bunch of these different crises, and then sort of trying to work out does it apply to now? And so if you look through a price is high relative to traditional measures, and you'd go through and let's say we're picking China again. That last column was 2015, but I think most of it sort of applies for now. Is you say yes, are they prices discounting future rapid price appreciation? Well, yes, to a certain extent in terms of the property values, but I think that's probably hasn't been the case for a few years now. The price has been going backwards for a little bit, but I think there's certainly the price to income levels and things like that you're looking at within China, and even just price to rents sort of would indicate that to make money on it, you've got to get price appreciation. Are the purchases being financed by high leverage? Again, in China, you'd say yes. Are buyers or companies making forward purchases? Well, China's marked as a no there, but I think for the developers, you'd certainly answer that as a yes. And what I mean by that is they were certainly taking out effectively loans from their customers because they were getting the money before they'd even built the properties. And so there's this idea that are you taking out leverage on stuff that hasn't happened yet? And that's certainly been the case within China. New participants enter the market, so that's often a new one as well. Is that are you getting lots of new companies or lots of new? It might be foreign. All of a sudden, you got foreign lenders, or all of a sudden you got foreign buyers of real estate, or something like that. The broad bullish sentiment and does tightening risk popping the bubble. And so within China, those last three, I think you'd now say that they've all turned to no's. And so, I think you can build the case that yes, all these sort of fit for China as the bubble was building, but a lot of that's now turned negative and back towards something more reasonable. I think it's probably interesting to note Australia through some of these and if you looked at the Australian house prices, is that are prices high? Yes, you'd have to say. Are they discounting future rapid price appreciation? Yes, that's again the case. Are they purchased by high leverage? Absolutely. Are we making forward purchases? No, not really. Have we got new participants entering the market? I'd probably say that's a no. That it's a flip between a no and a yes. The foreign buyers is no longer the case, as much of the case as it used to be. But we've got these massive levels of immigration sort of helping to push prices up. And so if those come back, then that's that marks that one as a yes. Is there a broad bullish sentiment? I guess you insert your own case here. I think there's I would call it resignation in a lot of cases to the fact that, hey, property prices are high. They're probably always going to be high. Whether that's the case or not, but I think there's certainly a resignation to higher prices. And just tightening risk popping the bubble, yeah, I think that probably does. But that's a question about will the RBA keep rates higher for longer, and potentially higher for what we're seeing elsewhere. If you apply those same measures across the US, you actually end up with not a lot of concern in terms of those. Again, so there's some pockets, but broadly the US did deleverage post the financial crisis, particularly at the household sector, whereas you didn't really see that in Australia. The deleveraging really was pretty minor overall, and so still lots of debt around. And Europe sort of sits somewhere in between. Leverage is down, but growth is also down, and so there's sort of pockets of Europe again that might have some concerns. If we looked at bubbles and we say, well, what did happen during these bubbles? Did you have debt growing faster than incomes? Most of the time the answer was yes. Income. Did you have this extended equity markets rally, and did you have a yield curve flattening? Well, you can tick the boxes in almost all the countries there, particularly China. In the last few years, that debt growing faster than incomes wasn't an issue back in the sort of early 2000s, but absolutely became an issue in the last sort of five or so years. The equity markets have been kind of coming back quite a lot in China. So despite the last few weeks, we've seen a pretty impressive rally. Equity markets have sort of fallen a fair bit, and we have certainly seen yield curve flattening in a lot of places, and negative yield curves. So typically, a bubble would see leveraging at sort of 20 to 25% of GDP over a 3-year period, and that's certainly been the case. Within China, not quite, no, not there in terms of the US or Australia, particularly. I guess if you broke down sort of more into the consumer or the corporates, I think you've certainly seen government lending up a lot. But if you're not as worried about a sovereign debt crisis, then that's not as much of an issue, I guess, in terms of, are we going into a debt crisis sort of based around consumers? So you've seen debts increase, but it hasn't been to the level, so Australia and the US, that it hasn't been as rapid as what we've seen elsewhere. But the flip side is, you've certainly seen equity markets been very positive. The issue in a lot of places is whether you've seen, certainly a lot of these bubbles, is have you seen monetary policy helping to inflate the bubble rather than constrain it? And so ex-China, I think that's probably not the case. I think monetary policy within China has been cutting rates for a long time and lowering. So you've seen that monetary policy trying to support the bubble, I guess. What do you call it? Inflating the bubble probably 5 years ago, but certainly trying to support it at the moment rather than constrain it. I think that's certainly the case. I think the inflation we had sort of really drove central banks to sort of ignore asset bubbles, so to speak, in terms of what they're doing in terms of interest rates. So I'd say within most developed countries, monetary policy was working counter. It was working to constrain the bubbles, or certainly the asset price bubbles we've seen over the last few years. So not as, that's, I guess, one more reason why we're not as concerned sort of ex-China. One of the key things you see that's the build up of the bubble. Now if we're talking about bubble popping, and arguably that's where we are in terms of China, and elsewhere, you'd say, well, could this be the next stage? I guess this is the question: is if we are going to have a debt crisis in Australia, could we see that could we see a bubble popping, and what are the issues around this? So if you're looking at sort of a more normal recession versus one of these big debt crises, the issue you've got is that you get this imbalance between the amount of money that you need to service debt, and when you cut interest rates, that sort of solves most of that problem and gives you this positive wealth effect and stimulates economic activity and sort of eases your debt service burdens. And that's why we're not as concerned about the US, not as concerned about Australia, because you've got that ability to cut interest rates and to solve a lot of this problem by, if all of a sudden every mortgage holder has got half the cash flow concerns they do at the moment, then that's going to give you this positive wealth effect. It's probably going to give you higher prices. It's going to stimulate economic activity and get rid of some of these debt service issues. In China, that's not what's happening. They're cutting the interest rates. They're not finding, it's not helping to anywhere near. And that's where you do run into these debt crises, is because the interest rate cuts, have already reached low enough levels, or you've got these currency problems in terms of currency outflows and currency weaknesses. And, so you've got this floor on interest rates that's sort of higher because of these currency risk considerations. And that's exactly where China is sitting in terms of saying cuts its interest rates too far, and then we see a weakness in the yen, and with weakness in the yen, then you start seeing more of these trade issues and more of the problem that the rebalance in China, trying to get more money from corporates across to households, needs a higher yen, not a lower yen. And then also that most of the borrowers in China tend to be corporates, and so by cutting rates, you're often supporting corporates and punishing households. So there's there is sort of lots of sort of issues within China that sort of that suggest that if you get these if you do get these bubble poppings, things could be worse. The other issue is about this willingness to spread the pain amongst everyone, or whether you get these the bits about the sort of the moral outrage and the people who borrow the money, they're the ones who are going to have to pay the pain. So that's all about this policy response. and this last one I've got on that list about victim narrative, and it's really important in terms of trying to work out what's happening there and what's going to, are you going to end up in a debt crisis, or are you going to end up in sort of these long, slow recoveries? And so what we saw very much within, say, Japan, as Japan sort of hit that level, was they wanted to spread the pain amongst everyone. It was not about saying we're going to take, the companies that are over leveraged are going to go broke, and then their shareholders going to suffer and their debt holders going to suffer, and then we'll get back to it, which is sort of what tends to happen in the US, or what we saw happen in Iceland. But if you go down the path of, no, we're going to spread the pain amongst everyone, and we're not going to have these victims, then you get, lower. The trough is lower, but it gets extended for a long period of time. And so that's, it's sort of, that's where we'd suggest within China, you are looking at this sort of spread out pain and trying to support, say, the developers, property developers, by spreading the pain out, or trying to support property prices by governments buying more properties and trying to support the property price, which is effectively saying, well, that money's got to come from somewhere eventually, whether it's a government borrowing or bigger taxes in the long term. And so the question about saying, are we just spreading that pain out amongst future generations to prevent sort of people at the moment having problems? And so so these would all point to some of the other things you need to do is make sure you're curtailing any panic and sort of guaranteeing liabilities. And that certainly seems to be happening in China. The question is, if we do get a debt crisis in Australia, I might exclude the US at the moment because of the stuff we were talking about earlier, that doesn't seem to be that far away. It doesn't seem to have the same debt bubble concerns. But if we're talking about Australia, would you get these guarantee of liabilities and this idea that the central bank's going to step in and try and support everything? And based on the way they reacted to the last two crises, absolutely. Are they going to provide liquidity? Are they going to create new rules? Are we going to see accountancy rules change? Are we going to see the way like we did during the pandemic, all of a sudden that insolvencies didn't need to happen? Absolutely. The Australian government, the Australian central bank seems to be, on the case for that. And so all these cases sort of point towards, well, both Australia and China point to saying, well, probably not a depression, in that most of the policy responses you'd expect to want to see to avoid the worst outcomes are likely to happen. The question is just then, does it end up being this sort of long drawn out event rather than a short, sort of more shorter and sharper? So I've got a table up to sort of showing what tends to happen in these crises. What are the proportion of cases where you get these emergency lending and liquidity, bank liability guarantees and deposit freezes and, all these types of factors that are going on. And look, a lot of those are going on in China, as we speak. So, the question is, within Australia, would you see some of these? Yes. Would we see the ones where losses imposed on debt depositors? That one I'm relatively doubtful about. I think there's Australian regulators have shown a pretty they've shown that they do want to protect even bondholders from losses. So getting down to depositors would need to be a pretty severe event, I think, in my mind, before you sort of got to those stages. The typical types of things you should be worried about, though. So if you see austerity come out, then that tends to be where we run into bigger problems. So we saw that in the European debt crisis, where the northern European countries were trying to sort of instill austerity on the southern European countries, and that sort of led to much bigger problems. So if we do start to see that, say, within China, that this idea that maybe we need to pull back on fiscal spending and things like that, that's a sign you're headed for quite a significant downturn. That doesn't seem to be happening. When you're seeing a lot of government printing, I guess that's a a positive support in terms of money when you see debt defaults. So you basically see the fastest recoveries come when the sort of magnitude of events, these debt defaults are recognised quite quickly, and the idea is that they're not out there to save every institution, and it's about saying how can we sort of create and restore credit pipelines, how can we get growth going and get to acceptable inflation, and sort of fixing root causes, or is it about sort of simply restructuring the debt so that you're distributing the pain over a broader population and over a longer period of time? And so within China, have they recognised the magnitude? Probably. I think there's there's probably not. Probably within some areas, I think the magnitude is recognised within certainly recognised within the property sector. Maybe the overall property market, I think there's signs they're trying to prop it up, and so I guess you'd say that yes, they recognise how big it is. Are they going down the path of not saving every institution to a certain extent, but also that there is a part of while there's some they're allowing to fail, they tend to be propping up and helping out with sort of the stronger are helping the weak and sort of forming sort of more weaker companies. Are they keeping the credit pipelines open? Absolutely, they're keeping the credit pipelines open, but part of the problem is people aren't borrowing. And then are they ensuring acceptable growth and inflation conditions? And that's really where they're sort of falling down in China in particular, is that we have the sort of pretty broad deflation now through most of that economy. And while you've got growth, notionally you've got growth there, the question is, the quality of that growth, and is it sort of focused in the right areas? Is this trying to fix the root causes of the problem, or is it just restructuring the debt so the pain's distributed over population and time? And I'd come back to saying, well, that does very much seem to be distribution across the rest of the population. Yes, so that's sort of more signs. Once you get to that, policy responses, I've just got a few up, that I might. These will be in the slide pack afterwards. I might leave these for after. Actually, we'll jump into a sales message first before we jump into this.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yeah, so it's just coming back to policy responses. Now these policy responses are sort of drawn throughout the phase. So the idea is when you're building this bubble, what you really should, good policy is central banks that are considering this growth in debt, and they're trying to restrain credit at the wrong point, at the right point of the cycle while it's growing. Whereas the bad policy is you're getting bubbles fueled by speculators and lenders over extrapolating past successes, and they're just bundling more debt into it, and you've got central banks sort of either not watching or reducing the amount of the lending standards at the wrong point. Now that's not the case in the US. Certainly, we've seen not only have we seen interest rates significantly higher within the US, you've also seen increase in lending standards for some time now, and so so that's just sort of one more reason why not as concerned in the US. In China, we certainly saw the opposite happen, and still it's about China's sort of trying to push can we get people to lend more? Can we lower the limits? Can we reduce the amount? Can we, they're into the pushing on a string stage, but they're the same policies, I guess. They certainly weren't trying to constrain the speculators and lenders. Australia, look, in the last couple of years, given the amount, so there hasn't been a lot of loosening in terms of the credit criteria, but there's suggestions now that maybe they need to be loosened. Hopefully, they're sort of beaten back, and so you don't have this sort of final push where, particularly if we start seeing interest rates getting cut in Australia as elsewhere, you don't see this sort of final push for people to try and get more, less stringent lending standards at the wrong point of the cycle. But but the real place of concern again is China for that sort of policy responses on the way up. At the top of the bubble, again, the good policy is you've got central banks sort of constricting and then starting to cut rates, whereas the bad policy is you keep tightening well after the bubbles burst. So given we've already seen the US cutting rates and we sort of haven't really seen this bursting of any bubble over there, one more reason why debt crisis in the US is less likely. China hasn't been guilty of over tightening, I would say. And the question is, I guess it's an open-ended question for Australia. If we started to see interest rates continue to rise or stay high for too long, then maybe you're starting to run into those policy issues. Depression policies, and let's focus on China now at the moment because they're the ones you're sort of worried about the policies there. They're certainly providing ample liquidity, so they sort of fit with the good policies. Are they pursuing aggressive and sustained fiscal stimulus? Sort of. I mean, I guess the fiscal stimulus has been ongoing for so long in China. It's hard to grow up more than what it's growing at the moment. They're starting to flip away from some of the old ones and then onto new ones. So there is still fiscal stimulus. Is it targeted in the right area? There's a pretty open-ended question there, and probably not. But and are systematically important institutions protected? Absolutely, they're supporting domestic ones. So all these signs, you could nitpick with it, but certainly you wouldn't say China's going into the into major risk of a significant debt crisis. Of an acute debt crisis. It does seem as if it's going to be this long, drawn-out event, which is sort of coming back to these policy responses. Once you sort of hit the deleveraging stage, then what you're really looking for is you're starting to do the reflation. So you're starting to get these aggressive monetization through asset purchases, currency declines. You want to get growth up there. You want to stimulate macroprudential policies to protect, and really to stimulate this high quality credit growth, and sort of manage, balancing depressive forces of defaults and austerity with reflation. And so China's sort of doing some of this. China's doing. You'd say that there's certainly elements they're doing well. I think the deflationary side they really haven't dealt with. And the whole asset price, you haven't really seen a clean out. So it's really just been about this shifting the debt around. So, so the net effect is on all that, you say, well, is a debt crisis likely? No, it actually looks across all those ones. US, because the debt just build up wasn't quite there. Australia, because we've got a lot of scope to cut interest rates, and probably you'd see a lot of the policy responses that you'd expect. If we do start seeing some sudden declines. And China, it looks like, yes, they've done a lot of things wrong, but rather than acute crisis, they look like they're really just trying to shift this across and push it out onto future people. So just one more quick sales message, and we might do a quick wrap up of what this means.
We'll be back again shortly. But want a low-cost passive option? Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so I think I just want to frame this in terms of investment outlook, and what I'm trying to talk about here is I'm not saying there's not debt problems, and we're not over it. We don't have various places and entities that are over indebted. What we've been looking at really is this idea of a debt crisis. Can you have this massive cathartic debt event that sort of drives you into this depression and really smashes earnings and ends up with much higher unemployment and all these other factors like that. And so what we're saying is these things can happen, and you can have pandemics and other things like that. So that things can come out of the blue, or wars, or whatever it is that can affect this. But if you're looking at the scenarios in the US and the current situation within the US, and you're looking at the scenarios and current situation in Europe or Australia, it doesn't have the same setup that you would typically have before you go into a big debt crisis. So of all the different factors we've looked at over this period, is you haven't seen the same build-ups, and you do have policymakers and who've displayed in the last couple of events that they do want to move fast and typically do the right type of thing in order to get you out of these problems if one of them emerges. Australia's got a few sort of slight more question marks, mainly around interest rates, but our expectation would be the biggest error in Australia would be holding too far or raising too much and actually having a crisis start to unfold that the RBA just missed for whatever reason. That's your big risk, and then held interest rates too far. But you'd probably say that's an outlier, not a base case. So where I guess the issues keep coming back to, though, is in terms of China and saying, you had all the conditions building up to it to have a debt crisis. The issue is you have had policy responses that are suggesting you're not going to get an acute debt crisis that sort of ends up in a depression. Certainly seems like it's going to be deflationary and considerably deflationary, but the policy responses and the indicated policy responses seem to say that you're going to get this long drawn out Japan-style recovery to it, rather than sort of a short, sharp event. Now, that keeps coming back to what we talked about last week and these announcements about, there's been stimulus announcements in China but they just keep, they're announcements that just don't lead to anything significant. And we spoke about the scope and the size they need to be. And the announcements we've seen so far this week just continue to reinforce what we're saying is there might be, this might just be the start, and we might just keep getting bigger and bigger and bigger until eventually there's these massive events. But that hasn't happened, and the announcements have been coming out every 6 months for the last probably year and a half of like, there's this new stimulus, there's this new package, there's this new support measure. And so you can probably set your clock, and there'll be another one sort of early in the new year. China will come out and they'll announce there's a whole bunch of new things to support the property market, and we'll see iron ore prices rally and iron ore stocks rally, and then more details will come out, and we'll find out, no, it's just the same as last time, or it's not big enough, or it's not significant enough, and we'll see the prices fall back down again. And so that's where, can we head for a significant debt crisis in China? Look, it again, based on what's been happening, doesn't look like likely. It looks like a long drawn out event, much more similar to what we saw within China. What are some of the there's a whole bunch of other stuff we could talk about in terms of when you do hit that pushing on a string. What are the types of things that you can sort of see that are countries can do, and so what are the types of announcements you could look for from China to say that they're going to, the acceleration or getting out of this problem is going to be faster. Wholesale money printing is one that's been pursued a lot in the past. It needs to be big and bigger than what Japan did, and Japan obviously did it to a massive degree. So you saw in the past, Imperial China, the American Revolution, US Civil War, Germany in the 1930s, UK during World War I, sort of had these real massive increases, or whether you're just debasing your currency. So that's the type of thing that can get you out of that. It is hard to see that happening for China. There's a lot of complaints already about China, debasing its currency or holding its currency for too low for too long, and its supplies, whatever it is, 30% of goods, but only demand sort of 12% itself. And so there's this push-pull between saying to China, well, if you're going to try and lower your currency even further, then other countries is going to countries are just going to put up tariffs because it's damaging other countries. You're effectively stealing demand from other countries. One of the things you could that would be a really positive sign is this idea of helicopter money, and sort of direct cash transfers to households. So whether that's so whatever form that takes, stimulus checks. During the Great Depression, there was U.S. veterans bonuses, and there's a whole bunch of sort of things over the years you've seen in terms of this direct money printing. There was a suggestion that's going to happen within the latest China stimulus, but it's to the poorest households, and it's probably a very low amount. It's certainly not wholesale. There seem to be structural or philosophical differences in China that really suggest it's not going to do that, and it's not going to. But that would be a great sign if you started to see signs that there was big money printing and big transfers from governments across to households in China. That's a huge sign that you're going to get it faster. But really haven't seen any signs of that. And then the other one is, could you see some really big write-downs and or jubilees or things like that, where you saw, ancient Rome, again, the Great Depression, Iceland, all these major crises we've seen, but debt crisis before, where we've actually seen masses of debt written off, and then you sort of it's very painful for a year or two, but then you've hit the reset button, and then you can get back to growth, or you're going to try and drag it out. And in China, you're really not looking at debt write-downs in any significant sense. So again, just one more sign that's what you're headed for. I'll probably leave it at that. I haven't seen any questions come through so far, but certainly more than happy to. If anyone's got any questions, they want to either book a call in or send them through, we can certainly answer them in any of the things we're writing up. Quick note that you can get our research or across our website. You can find our podcasts across all the major podcast platforms and on YouTube. And if you've got any questions, leave a comment, or certainly feel free to contact us a multitude of different ways. And we look forward to seeing you next Thursday again at 12:30.